Essentially, what you want to do is to supplement Social Security, you can actually switch over to a dividend portfolio or dividend stocks, which again, we're going to be looking at in long-term returns. Some of them do see some considerable growth, but overall, we want to check these out. First one we're looking at is the Wisdom Tree US High Dividend Fund. This, of course, is a large cap global stock, one that I haven't covered before. This is the ticker symbol DHS. Now, the ETF currently has a dividend yield of 3.5%, so a little bit lower than we traditionally see, even thinking of CD yields, things of that nature, a little bit lower on the side. I even have high yield savings accounts that are yielding 4%. But when you compare it to the S&P 500 that yields a 1.2, it is really a big difference. Now, the one with this one, even though it is a lower dividend yield, you are seeing a very concrete, fairly safe, large stocks that generate a lot of cash flow and companies that have a ton of money. When you start looking at oil, natural gas like Exxon, looking at tobacco company Altria, also looking at pharmaceutical leaders Abriv, they are really stable. They are companies that have been around for quite a bit of while, and overall very stable. Now, within this ETF, it does have a lot of different stocks, but the portfolio has 388 stocks itself. So we're not just going in with 1, 10, 20, 50, 388 stocks in this portfolio, which of those companies, they have to have paid dividends over the last 12 months and have a market capitalization of over $100 million. So when we think about large cap, that's exactly what they're looking for. And they're looking for companies that are consistently paying dividends, which is crazy. Now, the big difference with this one, rather than weighted position in the portfolio by market cap, which is what we usually see, or by dividend yield, which is another one we see, it weights it by the total amount of dollars that are distributed in dividends, meaning the larger holdings that they have, the higher dividends, they're going to, larger companies will pay out a higher total dividend. But because a company has a high market cap, doesn't mean it will pay out as much as a smaller company will. So very cool to think. So the weight is based it off, one might call in this article, market cap of the dividend. Nifty way of balancing size and strength with the dividend yield. It is not all into just heavily into these larger companies. Now, this, of course, has a risk compensation, which return on equity momentum factor, it is relatively low when it comes to the stability. If the goal is to keep risky stocks out of the portfolio, this ETF is absolutely perfect because it has a very low risk overall. Interestingly, the ETF won't hold a top 5% of stock with the highest dividend yield. So again, it's not going to be concentrated in one single company. Seems kind of counterintuitive,